Okay, I think it's about time for us to get started. I want to welcome everybody. We have at least 100 participants right now. We had 200 registered or more. Just a reminder that this is actually a recorded uh, virtual town hall, we'll call it for right now. So the goal for us is that you don't have to be in a position to try and write everything down. You don't have to remember everything. We are going to post it afterwards. My name is James Gore. I'm a Sonoma County Supervisor. Recently, I was at a conference of the California State Association of Counties, all 58 counties in California, meeting to go through policy goals, budgeting, legislative issues, and updates. I want to thank Ada Waelder, who's here with us from the California State Association of Counties. I was the president about 3 years ago of CSAC, California State Association of Counties. At that time, we were going through our fires and our disaster recovery, and insurance was a top issue. I was in a position with other county leaders to sit down and negotiate and communicate with our insurance commissioner, Ricardo Lara, and as well as the insurance companies represented by the Personal Insurance Federation of California, PIFC, which is the trade association for the insurance companies as well, and to figure out where we were, what we were going through, and where we needed to go as a state. I say that because really we're here for two distinct reasons. Number one is we want to talk about what the updates are from the state. That is an effort, an agreement between the insurance commissioner's office, I would say indeed also the governor's office, and the insurance association, including the predominant insurers, homeowners insurance policies here in California, on a sustainable path to come back into areas where we're seeing policies drop right now. And at the same time, another thing that we might talk a little bit about, which is to depopulate the FAIR plan, meaning the goal is to not have homeowners on the FAIR plan for multi-years. It's actually to get 85% of the people who are currently on the FAIR plan back into insurance. So I had a chance to meet with a group of supervisors and Ricardo Lara, and also sit with the Insurance Federation. And it was the first time that I heard them speaking the same, singing from the same music notes. They were saying that the agreement was in fact reached, that they were moving forward with this. So in a bit, we're going to go through that. And then the other side of this is just we have Annie Barbour and Emily Rogan from United Policyholders. Many of you might know who United Policyholders are. It's a group that a nonprofit that does an amazing job of neutral, fair representation of helping individuals with either disasters or understanding their insurance and what it really means in the coverage. If you're like us, is that many of us, when we went through our original set of fires, most individuals who had a policy in their hand really didn't know what it meant. So when they went into discussions with their insurance company, there had to be a lot of work to catch up just to understand what the policies meant, what the coverage was really going to be out of it. And Annie, I really want to thank you for reaching out. Annie is a fire survivor from Coffey Park, lost her home, but she is one of the epitomes of in our community of individuals who went from victims to survivors to really thrivers. And you go into almost every disaster community now. After I saw you in Lahaina, I know you've been in Colorado, Oregon, and others. And so this practical on the ground information is vital. So having that be an overview, now I'm going to pass it over quickly to Jenny Chamberlain. Jenny is chief of staff for me in our office. And Jenny's going to go over a couple just lay of the land for the Zoom itself.
Good evening, everyone. Thank you for attending our webinar. I'm glad you're here and hope that this is very fruitful for you. Today we have a large group today. We have over 200 people who signed up. So we likely won't be able to get to every question. I know that there's a lot of questions. You have the opportunity on your Zoom view. You see a Q&A question there. Please put your questions there. We're going to try our best to get to every question. We do ask that your questions are related to the material. If we can't get to everyone's questions today, we will provide emails and information. You can email our district office. You can email Annie from United Policyholders, and they will get back to you with the questions that you have. And again, thank you for coming. We'll, at the end of the webinar, we'll provide the questions. And as mentioned before, this is being videotaped, so this will be provided on our YouTube, our newsletter, and our social media as well. Thank you, and thank you for attending, and have a great evening.
Okay, so to run a show, I'm going to give a little overview of where things stand with this so-called Sustainable Insurance of the Future agreement with the Insurance Commissioner and others. Ada from the California State Association of Counties is going to lay in and give us a lay of the land of what led up to this and what's the process going forward. We're going to include links. I think some of them are already up there about 2 of the regulations that have been introduced. One is around catastrophic modeling, and the other one is basically a cleanup of how to for the insurance commissioner's office, how to process basically requests and changes to policies and things that come in as they being a regulator in the insurance industry, being somebody who submits either increases in policies or others, but there's going to be some information there. Then we're going to do a little bit of a stop. We're going to stop talking about policy and about the effort to stabilize the now and provide an availability for an insurance in the future. And we're going to go over to Annie, and Annie's going to take us through a brass tacks on the ground. If you are getting calls to meet with your insurance companies, if you're getting bad news, if you're concerned on your own right, if you also want to just understand more about your policy, how you go about that, how you use the resources of United Policyholders, how you approach brokers, how you do the work that's needed on the ground. Once again, we're sorry this isn't a full dynamic town hall where we can talk to you and sit down, but we're starting to get these updates, and we're getting hammered by people who have concerns and requests. So we just want to make sure we get the information out there. So from now until about 7 tonight is when we're planning to do this. We're planning to leave you with contact information so that we can continue onward. So I'm going to start from a pretty high level and just say, as I said before, I won't repeat it, but we met with both sides, the sides of the insurers and the sides of the insurance commissioner. For the last 3 to 4 years, they have not been singing out of the same music book. A lot of what you've heard out of the insurance commissioner was an effort to build out the FAIR plan, of a true homeowners insurance plan. Ironically, the FAIR plan is actually funded by the insurers already. It comes out of a fee for what they already get to provide to the state. And then on the other side, there was a lot of pressure from insurance companies to say, we need to be able to increase fees if we're going to stay in these markets. And there was a lot of understanding from the insurance commissioner also is that under things that Ada will get into, which is like Proper 103 and current regulatory machinations and bureaucracy, is that if a group, whether it's State Farm Farmers, any others that are out there, AAA, if they were to submit and the insurance commissioner approves an increase in rates of 20% over 2 years or whatever it might be, the way the current system is set up and the legal parameters around it would require 2 years for that to take place. So the big thing that both sides are talking about now is that the focus is on availability before it gets to affordability. That might be tough for many of us to swallow, but yet at the same time, I think if you're in a situation like I am in Sonoma County, is that having an option to say in between the maybe $1,800 to $2,000 I used to pay pre Tubbs fire on a homeowner's insurance, and if I get completely kicked out and having to move over to $14,000 or $15,000 for a FAIR plan and 3 adjunct bolt-ons with from the risk pool and other things, is not where we want to be, where it goes from cheap insurance all the way up to no insurance instead of its after tax funds that you're just paying an astronomical amount on. So in that sense, is that insurance is going up. If you've gotten a call from your insurance agent and your policy has now been dropped, you're being advised that your insurance is going up 20%, 10%, 15%, other areas like that. So affordability is something that they're not focusing on right now. They're trying to stabilize the market, is what they're telling us. So the 4 areas of the agreement, and Ada, I'm going to let you get into some of these more and some of the background of the governor's executive order and what happened or did not happen with the legislature last year. So I'll just hit these real quickly, is that there's 4 key areas that have to be implemented in regulation. Number 1 is the allowance of catastrophic modeling rather than historic modeling. So the insurance companies are saying for us to be able to write policies in the future in California, we can't just go over historical usage. We have to be able to do catastrophic modeling. We have to look at what the current situation is and the future. I've said this before, but posted, I believe in the Q&A by Teeth, is a regulation that has been introduced on catastrophic modeling. All of these require public comment or public, even the department has to respond to the public. So you'll see a link to that there on the catastrophic modeling. The second one, which the insurance companies are really calling simply timing and processing and streamlining, has a much larger title to it. Like anything, it seems like it's become quite bureaucratic. It is called New Regulation to Improve Oversight and Handling of Insurance Rate Filings. There is a link to that regulation as well. So anybody who wants to be involved in what's happening at the state and with the insurance commissioner, those are the 2 areas that have been introduced right now as regulations. There's 2 others, which are updates to the FAIR Plan. And there have been announcements of how to restructure the FAIR Plan, but ultimately that is still a dynamic thing that's going to be further introduced. And then there's another one on reinsurance. And I don't have a big update on that right now. We're trying to get more information. But the idea of reinsurance is, for those of you who don't know, is insurance companies have insurance as well, right? And so there's a whole dynamic about not just how much an insurance company has, but really what's the global market that's underwriting these claims or policies. So those are the 2 that we expect more action on and more updates. But those are a part of what both Laura and the insurance industry are going out and saying is the agreement. And under that agreement, there is an effort to depopulate, as I said, the FAIR Plan, take 85% of the policies off of the FAIR Plan and get them back into policies. And then the insurance companies are agreeing to create new policies into these burdened areas, these high risk areas. So I'll stop there for a minute and just say that we have to track this, we have to watch it, you have to be involved. We're going to continue to find ways to provide updates. But at least things are, for the first time in a long time, moving in the right direction. Ada, I want to pass it over to you, and I think you're going to go to Annie afterwards. Thank you.
Absolutely. Thank you, Supervisor. I'm really happy to be here, and my whole goal in this is just to give you an update from Sacramento. So, quite a bit of what the supervisor said is included in my presentation as well. I am trying to keep it high level. I know that some of you probably are insurance experts, and some of you have never had to think about insurance in any sort of meaningful way until you lost your insurance, or your parents did, or the people around you, started not being able to buy homes because of the insurance crisis. So I'm trying to walk the fine line between those 2 things. Some of you will already know this, and some of you might be brand new. So I am going to go ahead and pull up some slides just to hopefully make it easier to follow. I will make these slides available afterwards. I'll send them to the supervisor's office, so if you'd like them. So the current state of insurance, as Supervisor Gore laid the groundwork, since 2022, we've had 7 of the 12 largest insurers in California who have left the market. And by left the market, a lot of the times what that means is that they're just not issuing new insurance, homeowners insurance. The really big sort of straw that broke the camel's back that I would say led this to a crisis was in 2023 when State Farm left, and State Farm held 21% of California's homeowner insurance policies. As a result of this, we've seen the FAIR Plan double in the number of folks that it is serving, and the FAIR Plan is supposed to be our insurer of last resort. Since 2018. So that's only 3% of the market, but that is way more than what it's supposed to be. Because the FAIR Plan is intended for those who don't have access to insurance elsewhere, it's really highly concentrated risk. And all of this, the FAIR Plan is fully funded. All of this risk is funded by fees that the insurance companies themselves pay. So this is not, state funded. And that's part of the reason that, the insurance companies are also leaving. They also assume a portion of the risk that comes within the FAIR Plan. And I heard a stat the other day that the FAIR Plan receives 2,200 calls a day. So I'm sure many of you who have tried reaching out to the FAIR Plan individually are having a hard time getting through. It's become really untenable. And Supervisor Gore also mentioned this issue of affordability versus availability. So on the one hand, we want insurance that folks can afford, but what we're getting to the point is that even if you could afford the world, you might not be able to get a plan, and that's the availability piece. And I just wanted to, another few numbers on here. California's average premium is $1,403, as you can see, compared to Florida at $2,407 and Louisiana at $2,259. That is, it looks good on paper, except that if people can't get their insurance, then it's not really going to do us much good. And as we just pointed out, those rates are really high in other states. California is unique in its issues that led to this crisis, but we are not alone. Insurers are pulling out of Texas, out of Florida, out of Louisiana. I've had my colleagues in Washington State express that they're concerned. And a lot of this is because of climate change driven catastrophic weather. We're having these big storms on the East Coast in Florida. It's more around flooding, but fires throughout the West are leading to a real identity crisis in this country around insurance. Okay, so now we're going to get a little bit in the weeds here. In 1988, voters approved Proposition 103. So Proposition 103 was intended to protect consumers, and it's credited a lot for keeping those insurance rates low compared to other places in the country. It immediately cut rates by 20%. It requires all new rate increases to be approved by the Department of Insurance. So anytime your insurance company wants to increase your rate, they have to go through the Department of Insurance and get that approved. It established what is called an intervenor process. So if that new rate increase is over 7% or more, then that opens the entire process up to hearings that third-party interveners who are advocating, supposed to be advocating in the public interest, are able to then step in and question and prod the insurers on why their rates are increasing in that way. And that intervenor process in Proposition 103, it establishes that if that intervenor contributes in a meaningful way to the hearing, that they're able to recoup their costs from insurers. They have to pay for their time and resources that were used. It also prohibited using the cost of reinsurance in rate setting. So when these companies are going to the Department of Insurance and saying, we need to increase our rates, they aren't allowed to use that reinsurance case. And as Supervisor Gore said, reinsurance is essentially the insurance for your insurance companies. And that can get quite expensive. It's a global market. And so they don't have control over what those reinsurance costs are. And then it also restricted catastrophe modeling. So catastrophe modeling is kind of the big game in town right now because there were recently regulations dropped on it. Essentially, insurance companies now, when they're setting their rates, they have to look at historic data on what their risk has been instead of looking forward. And from a consumer advocate perspective, there's often been a lot of concern about catastrophe modeling being a black box. We don't know what's going into these algorithms that then are deciding how our rates are being set. But California is the only state to prohibit it. So the insurance companies are pointing to this as a really big issue, like a really big preventer in their being able to set rates appropriately in California. So that's Proposition 103. And this is sort of the in the weeds basis for how we set insurance in California. So we have this crisis, we have Proposition 103, who can fix it? Last year, legislators dove in August. There was a late in the legislative session play to try to get a deal on the table. It was pretty chaotic. There were some people in the room. There were other people not in the room. There were people willing to come to the table. There were people not willing to come to the table. Ultimately, the deal fell apart. A lot of the criticism was that the legislature is not really the appropriate place for a fix to go through. The Department of Insurance is meant to be in the weeds. The legislature is meant to be setting more high-level priorities. That was what some folks were saying. So following up in that, in September of last year, the governor issued an executive order. It sounds very formal, but essentially what he did was call on Commissioner Lara to take immediate action to address the insurance crisis. And that same month, Commissioner Lara announced his sustainable insurance strategy. And I'm going to go into more depth. Supervisor Gore also mentioned at the beginning the sustainable insurance strategy. I'm going to go into more in depth on what that meant. And then this is a little bit less who can fix it, but more who's examining it. In March 2024, the Little Hoover Commission announced that they're doing a report on the insurance crisis in California. So the Little Hoover Commission is an independent commission that exists to deep dive on issues and present policy proposals going forward. They've had a couple of hearings on this too now. Both of those hearings have included public comment. They will likely do more hearings in the future. And they also take written comments. So if you have specific stories that you want to share, the Little Hoover Commission is a really great resource on that front, and as in addition to the Department of Insurance. Okay, I'm going to go a little bit into the sustainable insurance strategy. So this was the policy basically plan that Commissioner Lara set forth. The first would be to increase availability in at-risk areas. So all of these insurance companies would have to commit to writing whatever their percentage of the market is. So, you know, if they have 20% of the market, then they need to write at least 85% of that 20% in an at-risk area. So they're required to issue a certain number of premiums, of policies rather, in those at-risk areas. These are all still in development. So we don't know exactly what that will look like at this point in time, but we're hoping to hear announcements on this soon. But that is prong one of the sustainable insurance strategy. Prong two is modernizing the FAIR plan. So Supervisor Gore mentioned depopulating the FAIR plan. The idea is we're trying to get folks off of the FAIR plan, which should be our insurer of last resort, and get them onto the market with the hope that they will have more affordable and better availability of coverage. Commissioner Lara said that he'd like to prioritize homes that have done work to mitigate fire risk. Again, devil's going to be in the details on these. We haven't seen the policy proposals, but for you know, counties like Sonoma, where there's a ton of work being done to harden your homes and increase your defensible space, this could be a really big for us. And then it also would expand commercial limits. So right now there's a $20 million cap on the FAIR plan for like apartment buildings. HOAs get caught up in that. That's going to be really big for not only the ability to recoup costs on those and get proper coverage, but also to ensure that we can continue fighting against our housing crisis in California. You know, having apartment buildings that have a maximum of a $20 million per structure, it ends up really limiting what developers are willing to do. And these are the two areas where we have seen some movement so far from the department. So Supervisor Gore mentioned, you know, that updating the rate filing. So in Prop 103, all of these companies have to go to the Department of Insurance in order to get their rates approved. This new regulation is aimed to sort of streamline that, to add transparency for the industry on how these decisions are going to be made and certainty on timelines. So they're not waiting 2 years for a rate increase. And then in March, they released the catastrophe modeling and mitigation regulations. So this is the first draft. There was a public workshop just last week. And then it's now going to be submitted to the Office of Administrative Law for review. This is really in the weeds probably for a lot of you, but once the OAL has you know, their 30 working days to approve it, then it'll go back into the regulatory process. And the idea from Commissioner Lara's plan is that we're going to have regulations, drafts at least, in place and moving forward by December of this year. So it's not a rapid fire, you know, quick fix for the crisis in the state, but it's quick as far as regulations go. And that is my primer here. Again, my name is Ada Waelder, and I really appreciate the time and getting to speak with you all today. And I will check out the chat if there's questions or the Q&A.
Thank you so much, Ada. That was, I think that's just, it's so important to know what the heck's going on or why things are the way they are. There's a lot of people who are asking why we're not seeing more bills in the legislature. One of the reasons is because that effort did not lead to results last year. There's actually some bills right now that are moving through that are looking at requiring this mitigation. Laura and others were very clear that in a way that's not going to achieve the results that individuals want. A lot of those are getting kind of quite honestly watered down because they're not a part of the regulatory process that needs to honor it. But the mitigation side of things and the ability to use public facing threat maps is what everybody is working towards. So Ada, that was excellent. I want to thank you very much. Annie, pass it over to you. We're going to go from high level policy down to brass tacks.
Thank you, James. Thanks, Ada. So welcome, everybody. Most of you know of United Policyholders because they came in and saved us from our insurance woes after the 2017 fires, the 2020, I believe 21. But we do preparedness and advocacy also. And so we just wanted to take a little time for my community to share what we know about what's going on. United Policyholders is a nonprofit that helps with navigating insurance, educating about insurance. We do not accept funding from insurance companies. We are only funded by grants and donations. And we've been closely monitoring the property insurance marketplace, coordinating with stakeholders to restore affordable options and working hard to help people reduce risk and keep property adequately insured despite a current crisis. The bottom line is why you're all here. Non-renewals, getting dropped, prices going up extreme, people not being able to afford insurance, California Fair Plan or surplus lines that are now coming into more into play that need the educational component explained. The California Fair Plan is overwhelmed, as Ada was saying, and finding a good agent or broker is very important. But at the end of the day, avoiding underinsuring your home is still very important. I say that because I know that people are struggling with the financial side of this, and I understand that completely. But we do need to recognize if we did have another catastrophic loss in this area, you don't want to be the one not being able to rebuild or recover. Affordability strategies, they're very similar to what they've always been: bundling your policies, working with a proactive agent or broker, raise your deductible. I have a $5,000 deductible. I am not going to file any small claims because I'm afraid I'd lose my insurance. So I really am just insuring myself against catastrophic loss until the insurance industry and California gets it together. So ask them for quotes. You're shopping $1,000, $2,500, $5,000. See what the difference in your premiums will be, and go with what you can afford. If you have a house that's insured for $1 million and you do not have the percentage of contents that $1 million would dictate an insurance company to give you, ask them if you can lower that. See if it makes a difference, but do ask them the difference in the price. If it's not worth your while, don't do it. Hardening your home, defensible space. We've been talking about this forever, and don't file small claims. So this is kind of where we're at, where we have to explain the lingo of insurance. If you're dropped or non-renewed, you know, in today's market, you're canceled if you, usually for unpaid premiums. This is the perfect time to make sure that you have instead of just getting your information from your insurance company and your billings in an email format, make sure that you get a paper copy also. People sometimes bury that email, and that's what we find is problematic. And then you don't get your premium paid and you get dropped, canceled. California Fair Plan, which we'll get to, and the difference in condition policies that you would need to piggyback that with. We'll explain the admitted and non-admitted market and the California Guarantee Association. And risk score. Everybody is talking risk score, right? So insurers must give 75 days notice that they're going to non-renew you. If they don't, you can file a complaint with the Department of Insurance. State Farm at this, ones that we've been hearing about are actually giving 75 or longer days. You want to use every single one of those days. If your insurer drops you, they have to tell you their risk score and offer an appeal process. And California Fair Plan must take all comers with very few exceptions, and they can offer up to a 15% discount if you meet the Safer by Fire, wildfire prepared home standards. Other insurers should be giving you a discount if you're reducing risk, but we're not really seeing a lot of that yet. And Ada did the sustainable insurance strategy, so I'm not going to do that. On our website, we have a whole section for dropped by your insurer. You want to start shopping right away. Get help from, you can do an agent, you can do a broker. A broker has access to many more insurance companies. We have heard anything from 5 to 90 days and how long it takes to get a California Fair Plan on your home. When you contact an agent or a broker, that should be your first question is, how long is it taking right now? You may have to get that started as they're looking for another plan for you. You do not want to end up going bare and not having insurance. So I highly recommend that you do that. You don't have to pay for the plan. It's an application process. And be prepared to take risk reduction home improvements. So there are 4 main types of insurance companies: admitted and licensed, non-admitted, surplus, government, which is the California Fair Plan, and the CEA, which is for your earthquake, and a forced lender place. And I want to discuss the forced lender place first. Many people think they get a letter saying that their mortgage company has placed insurance on their home because you have not secured it. What it doesn't tell you is you're paying a very high price to secure that mortgage. It will only pay the amount of the mortgage to the mortgage company. You will not have loss of use, contents, and or any of the equity that you've built up in your home. So it's really important to understand that and don't take a big sigh of relief and say, oh, it's okay, my mortgage is secure. So admitted is what your goal, your number one priority in getting.
Annie,
yes.
If I may, this is James. Can you go over that last item just real quickly? So if somebody does not sign up with and do a proof to their mortgage company, who owns a large portion of their house usually,
yes,
that they have insurance, do you have any idea how long it's taking for those mortgage companies to then find their own insurance and send a notice to a homeowner? Or how's it working practically on the ground?
I don't know the time frame. Generally, what we see, James, is the people who come to us after a disaster, and they say, you know, my mortgage company is saying that my insurance is a forced place insurance, and that I'm not entitled to any of it. And that's usually how they put the pieces together, unfortunately. So we've just added this piece into our educational part because it's becoming more broad. So in a perfect world, you'd like to be on the admitted insurance companies. They have an insolvency guarantee fund of up to $500,000 if they run out of funds, go bankrupt. Their rates and policy forms are regulated by the California Department of Insurance. We all know that this is becoming problematic to get one of these companies. So the surplus line, they don't participate in the California Insolvency Guarantee Fund, which means that if they file for bankruptcy, it's more like a get in line and hopefully you'll get a little trickle down. They're not regulated by the California Department of Insurance. The California FAIR Plan only covers fire, lightning, internal explosion, and smoke. You have to pair it with a difference in conditions policy, which covers your water damage, theft, and liability. And it's really important that you kind of put that plan together to get comprehensive coverage. And they have a $3 million max on residential, which means everything, your loss of use, your contents, and your home. So the California FAIR Plan it's structured where you actually create your own policy. And so the initial quote you may get, the policy they may offer you, you need to be really proactive and make sure that you have the things that you have in a normal plan. Replacement cost coverage is huge. Fair rental value, which we equate to loss of use or ALE, code upgrade coverage, and debris removal. This is a website that you can go on to find out these surplus line insurers, what their financial strength is. And I highly recommend that anybody who's considering going on to that they really dive into this to make sure that what they're paying for is what they're going to get. Risk scores, they're a big deal. I am almost embarrassed to say that in Coffee Park, we have a 0 risk score. It doesn't make a lot of sense. Obviously, I'm not railing against it, but I do recognize that it's not just this easy to understand process. And it makes a big impact on what kind of insurance you get. It takes out the human factor of coming out, seeing your property, seeing what mitigation you've done, and not just lumping you all in the same bucket. So this is the Department of Insurance has put together a wildfire risk score appeal process. And you can go online or call them to appeal your score. It's a tough process. They're just rolling it out. And I would recommend anybody who is really concerned about their score, doesn't feel it's proper, to file that appeal. We've all talked about hardening our homes, right? We know how we live in Sonoma County. We know how these fires have traveled. We know that embers have been a big part of it, coupled with hurricane force winds, and that embers are just floating everywhere as these things are progressing. So there's a set of standards that have been developed. Pretty much there's a few sets, but protecting your homes from ember fires, putting a 1/8 inch wire mesh on your vents and on your chimney so that ember can't get under your home, into your home, and start the process of a fire. Clear plants for your first 5 feet. And this list is great to have it all done, but we're very realistic, and we understand that you're going to be able to afford some of this. You're not going to be able to afford some of it all at the same time, or it doesn't make sense for you, and you're not capable of doing it. So 60 to 90% of home loss is due to embers. And I firmly believe that the fires we've had been predominantly the embers. The Wildfire Prepared. So this is a program of the IBHS. And they have this amazing plant in North Carolina. And I believe it's every guy's dream job. They build things to destroy them and see what they can withstand. And so they've done studies to find out what things you can put into place to hopefully safeguard your home. We have a RAP group. So it's, we get together once a month and we talk to people, firefighters, fire chiefs, insurance agents, and we do presentations, mitigation people. And it's a great resource. If you go on our site, it will tell you things like what kind of grants are available. What are people doing in different areas so that you can steal whatever is available to you. So Recover California has a grant to help with mitigation, as does Permit Sonoma. Please look into those to help you with your resources, and hopefully you'll qualify. I know that it's a little bit of work to get through these kind of grants, but it would really be advantageous. For the California Fair Plan, you do get discounts, which we have not really realized on conventional plans. You can get 10% for a hardened home and 5% for defensible space. And with the cost of insurance nowadays, not only would you be protecting yourself, but you're also going to be saving a little bit of money. So how do you qualify for these discounts? Well, there's a whole list of things that you can go on our site and you can see, but it's 10% discount for double paned windows, vents covered for embers, 6 inches of concrete on exteriors walls from the ground up, eaves enclosed. The 5% discount is for all for your surroundings, your outside. So at the end of the day, I think it's really important that everybody here understands your dwelling coverage A limit should be enough to replace your home with one similar size and features. And we really recommend you have 50% replacement value. You may only be able to get 20 or 25%. Put those two figures together and divide it out by your square footage, and you're going to know how much you have per square foot to build. Recognize that in a catastrophic loss, all those rates go up. Affordability goes out the window. So at this rate, I am actually overinsured on my house. Know what the value of your house is. It's not, so my house is paid off. My house has a lot more value to me now because it's not owned by the bank. So that's why, one, I'm able to insure it for more, but also, it's my future. It's all those things that are so important in your security. If you need help with figuring out what it would cost to replace your house, we do have this wonderful link to a company that has a $150 fee that will actually do the work for you to let you know, to give you that reassurance. You can talk to a contractor, you can go by homes that are being built, but in the big picture, it's very difficult to figure out what you need. It's not how much you could sell your home for. Nowadays, it costs a lot more to build a home than to buy a home. So be prepared. It's extremely important that you understand what else should be in your policy, your code upgrades, which will take your home from the year it was built to today's California code standards. My home was 1,500 square feet. 2018, it was rebuilt. It was born in 1970s. And it was $68,000 for my code upgrades. Now that would be almost $100,000 by my calculations. If you do not have code upgrades or law or ordinance in your policy, that comes right out of your pocket. Can't charge it to any other bucket. Your contents are pretty straightforward, but you will have to make a list. So we recommend that you go around your home with a video camera, with your phone, take pictures, open all those doors, all the cupboards, all the drawers, and film everything you have to make it easier for yourself. And if you have antiques, unique items, make sure you get a really good shot of those, because those cannot be depreciated. And you want to get full value, so you want to be able to take that to someone in the know who can do a proper appraisal. Your loss of use, thanks to 2017 fire survivors, has now, right now, if you have a one-off disaster, you have up to 24 months of loss of use. That does not pay for your mortgage. It pays for you to live someplace else that's comparable to what you had. And it will pay to rent your contents. You know, one of the guys in our group at one point said that he got out 2 tomato cans because he didn't have a rolling pin. It's so hard to replace everything. And most of the time you're wasting your contents money doing that, because you're living in a place that's not going to resemble what you're rebuilding, and it won't fit. So utilize your loss of use for that. I figure an inflated amount of rent for mine. I put in another $500 to rent my contents. And you can also, there's all sorts of different things you can add there. It's up to your insurance company to approve or disapprove. Usually they have a list, but that will be your lifesaver in not having to use your dwelling money to live. My little dog, I moved into my boyfriend's, and he doesn't have fences. And so I got them to approve an electronic fence, and I'm really glad I did. It was about $1,800. And she was younger and faster. And the first time she saw a squirrel, she blew through that thing like there was no tomorrow. So then I was really happy I didn't have to pay for it, because I knew that she would sit on the other side, but she would not, it wouldn't stop her from going. So this is what we've all learned in the process of recovery. Insurance money is your number one source of money that helps you rebuild. It's not government aid. It's not charity. FEMA is needs-based, and the maximum grant is $42,000, and the average is $5,000. So FEMA is not going to be a help. SBA loans are low interest, but must be repaid. You have to qualify for them. You have to play the game of appealing. So just so you know that how important insurance is, even though the availability and the affordability of it is difficult right now and offers all of these very, very stressful challenges, just recognize what it does afford you. We do have this wonderful California home survey, which I would love for all of you. It's how we keep touch with our areas. And we have one for Colorado, one for California, Florida, to see what the feel of the market is, what people are challenged with, and how we move forward in advocating for everybody. And if I could take just a couple more minutes, I'd like to share with you guys some tips that I normally share in a preparedness piece. Everybody, I would love for you to go and just write down 5 phone numbers, one being out of the area, and put them in your glove compartment. If you evacuate without your phone, we don't memorize phone numbers anymore, but you're going to want to connect with someone to let them know you're safe or to check on them. For seniors, for people who have pets or children, a lockbox on your house will enable you to call any of your neighbors and ask them to come over and help get those people out. Your prescription drugs, you may have them in your go bag, but take pictures of them, because if you are not home when you evacuate, you then can just take that in and get a emergency 5-day fill, and that will keep you out of having to try to navigate the doctor's office when everybody is standing in line. Don't let your gas tank get less than half full, and have some cash stashed away. You know, Maui lost their internet. How would you pay for gas, food, lodging, pretty key. And know your neighbors. Coffee Park, we had 5 fatalities, and that's 5 too many. I think we would have had a lot more had we not had a neighbor to neighbor, people knocking on doors, calling each other to get people out. So know your neighbors, know what their strengths and weaknesses, and step up and help each other out. And that would be it today, James.
Thank you, Annie. Thank you for your journey through this, and for Emily and our best to your other United Policyholder individuals who are out there. I think a couple other things is I know we have some folks who are local insurance company reps, and I want to thank you. You know, many of you have worked your butts off to be a part of this community and provide people great plans over the years, and you're making a lot of phone calls to your neighbors and others that you're not making the call on. I think that's a reminder in the days when we had our litigation with PG&E, we even saw some threats against PG&E employees. So we got to make sure we keep context of who's making what decisions and why they're being made. The mitigation world, I think, is definitely going to come with some of the regulations that Laura is doing, but it's also going to come after the fact. We had a very proactive group working with insurers to replicate a model we'd heard about in Boulder, where if you had a mitigated site, a fire-safe site, meaning home-hardened, defensible space around your property, and other factors on a checklist, is that insurance companies would actively agree to underwrite those areas. We were pretty far along in that process before basically the offices outside of Sonoma County and outside of California decided that there was not a sustainable solution, and they were going to stop writing policies. So you will see that kind of stuff come back, but we need to get through these regulations right now. I've seen a lot of questions that have been answered by predominantly Emily. Emily, I want to pass it over. Is there anything you want to add?
So there was a lot of good questions in the chat. I tried to answer as many as possible. You know, the one about risk scores, you know, that's a new law that your insurance company is required to provide you your risk score. They have to do it when you're shopping for insurance, and when you're up for renewal, and if they non-renew you too. So you know, it's something that we've heard consumers say that it's not quite worked out yet. So you do have the right to ask for it, and they are supposed to give it to you. If they don't, we want people to contact the Department of Insurance so they know that this isn't working, that they can maybe push out more communication so it doesn't fall on us, the consumers, to be like, wait, I thought I was supposed to get this. Another really good question in the chat that I just wanted to share with everybody in case they missed it was, how can I have the same insurance company as, you know, a whole bunch of people in my neighborhood and only some of us are being dropped? And, you know, really sometimes it could be market concentration, like the insurance company, you know, doesn't, when they're trying to thin out, that might be one of their factors. But also every house might be a little different. And, you know, people might have done different things to harden their homes than others. So, but that being said, it's always good to know your neighbors. Hey, what did you do? How come you know, just to see if you can find out that difference. It might not be as transparent as we would want it to be. And then finally, you know, taking those steps to harden your home, it's really important. Part of the you know, we heard from Ada that there'll be that with these new changes, the insurance companies are refiling for their rates, and they're incorporating these insurance discounts. So for wildfire home hardening. So the more you can do step by step, you know, focus on different things, it will help protect your home. And down the line, when hopefully the insurance marketplace becomes a little easier for us all to use as consumers, will there be more options, you'll also have access to more discounts. So it's kind of playing the long game, seeing what you can do, seeing, you know, what what's available, and then just take advantage of any local resources too. So, you can get a home assessment done for you. More and more, a lot of this is becoming, in the last couple of years, easier for the homeowner to do as well. And that doesn't mean you have to share it with your insurance company. It just gives you a roadmap of like, hey, how can I make my home stronger? So thank you so much.
And I'll just add to that really quickly. Thanks, Emily. That we're seeing people getting satellite or drone imagery from above, and they're being advised by their insurer to fix roofs, get rid of debris behind fences. So this is kind of our new norm, and people need to recognize that. And if you're deferring maintenance on your roof and they're only going to give you 2 weeks or 30 days to repair it, that's something you might want to get on right away, because they're out there watching.
I think one of the things that's a tough reality for us to take on is that our assumptions about what we should be covered on are not what the reality is gonna breach right now. Annie, you and I were having a conversation. You said, you're hearing from people who say, I was a good customer. I paid for 35 years. If you average out 40 years at $2,000 a year, which it wasn't consistently, that's $80,000. A full home replacement for many of those homes was $800,000 tenfold. And so what we saw with insurance companies that had reinsurance or those that didn't is that this is as we learn more and more, it's a weird global market with a certain amount of capital in it. And so unfortunately, it's not surprising that that this strange equalization of availability first and then affordability second is there. For those of you who are on a fixed income in a high, in a WUI, wild urban interface area, and maybe it's now going to cost you $7,000 to insure your home, and it was $1,500 before. And then also you have to do $20,000 in mitigation and $10,000 in home hardening. We just want to let you know that we hear you each and every day, and we're trying to continue to create programs that either provide stipends or subsidies to be able to do home hardening, as was mentioned, or we have a program. It's loans you can take out on your property that are paid back on your property taxes that are low to 0% interest that added home hardening. Sonoma County Energy Independence Program, SCEIP. We're the only county in the state that has that right now. Once again, we're going to post this. We're going to keep doing this on different issues that are hot. Sometimes we get into a place where we try to create a perfect town hall for months and months. I don't like to do everything on Zoom, but this was very effective. So Annie, and Emily, and Ada, I look forward to working with you all to develop in the future. Jenny, thank you for all your work, and Keith setting this up. It's a blessing to be with you all and serve. So onward and upward.